Welcome back to EDS, and in this video I'm going to show you the absolute best strategy to use to grow your portfolio as fast as possible and as consistently as possible this year. It doesn't matter whether you have a large account or a small account, this will work for every single account, and I'm going to show you step by step exactly what to do. So the first thing is open up your brokerage platform, and then you want to go over and open a watch list of futures contracts that have options available to trade on them. And the reason why is because we're going to write options contracts on the futures contracts, because that allows us to get a high probability of success, which is going to give us consistent returns. And then by using futures, that allows us to access span margin, which allows us to be capital efficient, and that's what's going to give us our high returns. This is why it works even if you have a smaller account. Now, if your broker doesn't have a watch list that displays this information by default, then just copy down these ticker symbols and just make your own custom watch list. Once you've got that done, you want to then get up IV rank, and then you want to order your watch list from high to low IV rank. And the reason why is because when volatility rises, option prices rise, and when we write options contracts, we are short those contracts, which means we want to sell high, buy low. So we want to sell when volatility is high, play the contraction back down to the mean or lower, and volatility is mean reverting, and it is contracting in the market about 80% of the time. So that's just one of the reasons why this strategy is so powerful. So once you have got everything set up like this, you only want to look at things to trade that have an IV rank of at least 30. So our cutoff point right here would be at the 30-year bonds with an IV rank of 32.1. Anything lower than this, we wouldn't be wanting to look at this right now as of today. And anything over 30 is considered to have a high IV rank. Anything over 50 is considered to have a very high IV rank. I like to be in the mid to high range, and one underlying that I thought would look that would be nice to trade right now is the euro. It has an IV rank of 64.7. It has an absolute IV level of 8.1%. And if you do have a smaller account, you want to stick to things like currencies, bonds, soybeans, because span margin takes into account the absolute volatility level or your IV level, and the lower your implied volatility is for that underlying, the less buying power that will be required to open that position. So with that in mind, currencies, bonds, things like wheat, soybeans are good for smaller accounts. If you do have a larger account, then feel free to trade whatever you like. Just whatever it is that you choose, make sure that it fits well in your portfolio. Don't be too heavy or diverse, or don't be too heavy or concentrated in any one sector or industry. Stay nice and diverse. Although with futures, you have a very, very wide range of things to trade, so that shouldn't really be an issue too often. So we selected the euro futures, and then we're going to go over to the trade tab, which is where we can see a list of option expiration dates for that particular underlying. And as you can see, we have our expiration dates on the left, and then next to it we have the correlating futures contract. You don't really need to worry too much about the futures contract. Everything is kind of done automatically for you. As you can see, February 7th, March 7th lines up with the H5 contracts. April 4th and onwards lines up with the M5 contracts. July 3rd and onwards line up with the U5 contracts, and so on and so forth. We want to focus on the option expiration dates, and the one that we want to pick needs to be between 30 and 60 days out in time. So there's one here with 56 days left on the contract, and that is the April 4th expiration date, which lines up with the 6EM5 futures contract. So we're going to open that up, and we can now see the options chain for April 4th for the euro. And very quickly, if you don't know what you're looking at, we have call contracts on the left, put contracts on the right. This horizontal orange line shows us where the price of the underlying currently is with respect to the strikes that you can see going down the middle. In the top right corner, next to where we have our IV at 7.9%, we also have our expected move, which is in parentheses, which is currently at plus or minus 0.02. And that's also visually displayed with this vertical orange bar, as you can see here. And we've also got these standard deviation levels shown by these dotted blue lines. So when we are writing options contracts, that means that we are short the contracts and we want price to stay away from those contracts. We do not want price to touch those contracts, and we definitely don't want price to breach those contracts. So we're going to use this information to create a high probability of success. How are we going to do that? So if we know what the expected move is, and we know that we want the market to not touch our contracts, then we're simply just going to sell contracts outside of the expected move, and that's going to give us a high probability of success. Now, the trick is to sell contracts outside of the expected move, but not too far out, because the further out you go, the less premium you collect and the less return on your capital you will get. So I like to be around the 1 standard deviation level. And if you don't have all of this information displayed on your broker platform, then you want to be around the 15 to 20 delta. And we also, as you can see here, we have delta, positive delta on the call side, negative delta on the put side. So we want to sell contracts between 15 and 20 delta. So we've got the 17 delta here on the call side. We'll sell that. We'll sell the 1.075 strike contract. And we have a 16 delta on the put side at the 1.01 strike. And as you can see, that pretty much makes us delta neutral, positive 17 delta on the call side, negative 16 delta on the put side. Now, what you'll notice is both of these contracts are outside the expected move. They are around the 1 standard deviation level, and they're between 15 and 20 deltas. So this is a good setup so far. And what we want to happen is for price to be in this range, in between our two contracts at the point of expiration, which is in 56 days time. Now, what's the chance of that happening? Or what's the chance of making money on this trade? Well, if you look in the bottom left corner, we have our POP, which is probability of profit, and that's our probability of making at least 1 penny on this trade, and it's currently at 76%. So we've got a 76% chance of this trade working out for us as of right now. Anything over 50% is considered to be a high probability trade. So this is a very high probability trade already. And if we don't want to wait till expiration, which we don't have to, we can, let's say we want to get out 50% of max profit. We have this P50 number here, which isn't displayed for futures, but for equities it is, and it's typically 10 to 15% higher than our POP. So our POP is 76, so our P50 is going to be in and around the 85 to 90% range. So we're looking at probabilities of success of between 75 and 90%, depending on how long we want to hold this trade. If we want to hold this trade for even less time, say we want to get out at 25% of max profit, we'll have an over 90% chance of success on this trade. So very, very, very high probabilities of success. Now, if we were to get filled at this mid price here, we would collect $725 in profit upfront. That's going to get added automatically to our cash balance. Our broker does that for us as soon as this trade gets filled, and our broker is going to need just under or just over 1.1k in buying power to open this position. So we're going to collect 725, and our broker is going to hold just over 1.1. So very, very high probability of success, and very, very high returns on capital as well. And don't forget, this is in just 56 days. This isn't a year, this is in 56 days. So how can we get an even higher return? Well, we just be more aggressive. So let's say we go to the 20 delta on either side. What you'll notice now is that we're now collecting $925. So our premium has increased, but our buying power requirement hasn't really increased that much. It's at about just over 1.2k, so about another $100 or so. So we're getting very close to a 100% return on our capital now, and our contracts are still outside of the expected move. We still have a 72% pop, and everything is still on track, and we're just tweaking the trade now to get the optimal returns. Now, there is no right or wrong answer. It just depends on what your risk tolerances, you can just go, if you want to be really risk averse, you can just go all the way to say a 5-6 delta, go close to the 2 standard deviation level instead of the 1 standard deviation level, and you'll now have a pop of 92%. Your P50 is going to be over 95%. You'd collect $237 in premium, and your buying power requirement is going to be just over 750. So your return does drop, but your probability of success increases, and it's like a seesaw. So you got your probability of success on one side and your return on capital on the other, and it's just about finding a balance for where where you want it to be. For me personally, I like to be between 15 and 20 deltas. If volatility is really high and the edge is super in our favor, then I might look to go to the 25 or maybe even the 30 delta, but I start off with a 15 to 20 delta and take it from there. So how much buying power should you be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template that's available for everyone to get a hold of. The link is in the description. Just click that button and it will take you over to this spreadsheet. And the way it works is you enter in the size of your portfolio at the top. So say if you have a $50,000 account, and then below that you can enter in the current VIX level. So say if that's 3.5, and then everything will be automatically calculated for you. It will tell you absolutely everything. It will tell you how to structure your portfolio, and it even gives you an explanation below as well. As long as you follow this, you will be absolutely fine over the long term. And if you would like to learn in more detail about what we do and how we do it, the link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you'll have access to our portfolio that allows you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals, and there's a 100% money back guarantee. So once you have studied the full course, followed some of our trades, if after 6 months you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk free. It's $9.99 a month to join right now. The price will be increasing, but once you're in, the price is locked in for you for life. And this isn't a scare tactic. The price was £1 before, it's now increased to $9.99, and it will keep increasing every so often. So you are rewarded for getting in early, and the aim of EDS Premium is to teach you the skill of writing contracts and managing your positions. We do not want to keep you dependent on us. We want to teach you the skill, and once you've learned it, it's something that you can take with you for the rest of your life. No one can ever take it away from you. It's a very powerful thing to know, and we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You are always welcome to stay and be a part of the community, but within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.